Hi, in this mini lecture, we're going to be talking about ethics and financial reporting. This has really been one of the biggest areas in business ethics in recent years, and I believe personally that it's really drawn attention to ethical situations at work. So ethics and financial reporting. Well, all companies have financial statements which show how well the company has performed in the past. Some of the more popular ones that you may have heard of are the income statement, the balance sheet, the statement of cash flows. Those are kind of the, the big ones that you'll hear about. And so the information from a financial statement is only as good as the numbers in the statement. And so if there's false information in those statements, then that's problematic for a variety of reasons. And sometimes this is done either deliberately or accidentally. So in the early 2000s, we came up with this idea of creative accounting. And this was the deviation from our traditional methods used to interpret an accounting statement. Um, and really, it was, you might have heard the term creative accounting or cooking the books. And so, what happened was there were a lot of companies that were making their financial statements look better than what the actual reality was. And what that led to was people investing in these companies and inflating their stock prices. And ultimately, these companies crashed because um, they could not fulfill their obligations. So it became a really big issue, and you can see some of the companies here. I've also posted a couple videos on the Canvas site to help you to better understand these situations that we're talking about here. Another ethical issue when it comes to financials is insider trading. Martha Stewart was a big one that was highlighted in recent years. She was found guilty for having insider information and then buying stocks or trading stocks based on that information. And so insider trading is really just the use of information that's not available to everybody in the public and to make decisions to buy stocks, to sell stocks based on your self-interest so that you can make money or so you don't lose money. This is illegal and it is actually you are able to be penalized with time in jail for this. So why is financial reporting so important? Well, the primary purpose of financial reporting or your financial reports, such as your balance statement, your cash flow statement, your income statement, profit and loss, etc., is to give interested parties the ability to invest with you, grant credit. It helps the firm to make financial decisions. It helps you to know the level of cash flows and whether you have cash to spend. It also helps to compute financial ratios, which are used in a lot of decision making. Um, these are also used, the information in financial reports is also used when determining how much a company is worth, when a company is going to buy or sell another company. And it helps to identify the resources and obligations of a firm. So what the firm owes to other people, what other people owe to the firm. So they're very important. So we have auditing and auditors, and so all publicly held companies are audited, and a lot of other, a lot of companies have audits. I know when I work on grants, where we receive money from a grant, that all has to be documented because we'll be audited to make sure that we spent the money correctly. Within a university system or a college, there are audits done to make sure that the money is being spent how it's said it's being spent. And so the annual audit inspection of accounting records and other information really says that these financial statements are done correctly. Auditors are considered the gatekeepers for the stakeholders. And so it's really important that a lot of times, almost all the time, a company will hire an outside accounting firm to do the auditing. Um, and so there's just, it's really a check and a balance system, which we talk about more. So the auditors are external and they verify the accuracy of the financial statements. And then the audit committees are internal and then they oversee that auditing and the control procedures. And so basically, it's a check and a balance. They're both making sure the other is doing what they're supposed to do. And hopefully, we aim to avoid biases that could occur, which could impact the validity or the value of our audit. So there's the AICPA Code of Professional Conduct. The American Institute of Certified Public Accountants established a code in 1988, which was based on the 6 principles that you can see here. We've also recently had the Sarbanes-Oxley Act, which was in response to some of these corporate scandals like Enron and WorldCom. It was geared towards publicly traded companies, which helped to establish transparency, integrity, and accountability of public companies. And this was really some of the biggest reform we've seen since the 1933 Securities and Exchange Act. So I'm going to let you watch the movie or the video that I posted on the Sarbanes-Oxleys because I think it can do a better job than I can actually. But it is some of the biggest legislation that and rules that have been set forth in terms of ethics and financial reporting. So some key influencers of fraud in top management are societal level, industry level, firm level, individual level issues, which you can read about in your text as well. And then I just wanted to cover lastly this framework for examining management fraud. And so basically what this says is that, there are some social industry organizational issues that are at play. And then we have some individual level moderators such as age, experience, education, self-control, etc. Then there's some managerial fraud, which can take place. That's either occupational or corporate. And then there are effects on shareholders, society, communities, employees, managers, etc. So it just kind of shows this framework of how fraud impacts a variety of people. All right, so I know it's a very short mini lecture. Again, I really want you particularly to watch the Enron example and then the Sarbanes-Oxley video, and then really just to understand that it's important to follow the rules and guidelines for financial reporting and not to falsify your information because A, you will get into trouble, and B, it really does have a negative impact on these stakeholders and shareholders and your community and so forth. All right, have a good day. Bye.